Hello, and welcome to the Wade Borth podcast. I'm your host, Wade Borth, and in every episode, my goal is to get you to think differently about how money works and ultimately to empower you to take control of your money and your personal financing system. Now we're going to talk on page 48. Nelson has a chapter called Expanding the System to Accommodate All Incomes. So Nicole, again, you're joining us to talk about this chapter just about accommodating all incomes, right? So there's a lot of confusion. It's a short chapter. It's a page and a quarter. There's not much there, but it creates a little bit of confusion for a lot of different people. But I think they miss the simplicity of what's being said in this chapter. I don't know. Do you have any quick things you want to start with or talk about here real quick?
Off the bat, doesn't all your money through someone else's bank?
Yeah. Doesn't all your money go through someone else's bank?
And really, in today's world, there used to be a time where you get your paycheck, go to the bank and cash that check. And so the money went into savings or went in a checking account, and some of the money went in cash home with you. But that's not even the case anymore. So now people are paid through automatic in the bank and now has to come out of the bank.
Yep. It's interesting. The thing that the bank wants is they want deposits, and they want deposits as fast as possible and as often as possible. So direct deposit, which works great. Sure. Who does it work great? Who does it work better for? It works great for us as consumers, as people that receive it. But who does it even work better for? The bank.
It works for the entity getting the deposit.
Exactly. Wells Fargo, for lack of a better word. They get your money 2 or 3 days quicker than if you had to bring in a paper check. Yep. And they had to clear somebody else's account. Yep. So now it's instantly there, and they're using it well before you even get out of bed. They love the idea of direct deposit. And then here's the interesting part, and we've said it before, but it's worth repeating. Do banks just sit on that money? They get your direct deposit. Do they just sit on that money? Or what do they do with it?
It's back out to somebody else.
Right. They're earning interest on your money.
They're using it. They're making it work. They're for their benefit, not for your benefit.
Yep. In Nelson's point on page 48, and they make a great living doing it. They put it to work, and they're making a great living in doing it. So, it just goes back to the point he makes here. He says, he's talking about the all-American male that's where 34.5% of every dollar goes to pay interest alone, back to somebody else's banking institution, or banking system, I should say. And once that money's paid out to that banking institution, that money is gone, lost and gone forever. It's paid to somebody else, and they're buying their Porsche with it. I mean, I always think it's funny when they say, oh, the banker's your friend. The banker might be your friend, but the bank and the bank institutions are not your friends. They see you as a way to generate revenue so they can buy their Lamborghini. That's really all it comes down to. And so, we've been conditioned to think that's the only way to get it done, versus saying we can attack the situation and make it our own, and so therefore that profit that used to flow to somebody else now can flow back to us. In here, this is where Nelson really starts talking about tailwinds, right? If we can understand what's going on, in the sense that we can take control of that banking function, and then we receive the interest that would have been paid to somebody else, and then we can grow a bigger pool of money, and then we can go find other people to go out and lend money to, and then we take that interest that would have went to somebody else's. So it comes back to us. Now we build a bigger pool of money. And this is what Nelson was talking about when he talks about creating tailwinds. Right. Now we have the wind blowing at our tail, so we're not just flying at 300 miles an hour. We have a 200-mile-an-hour tailwind blowing us at ground speed of about 500 miles per hour. And I think there's a lot of people that are confused by that, but you don't see it immediately. It takes time to have that start to happen. And quite frankly, this is the point where experience is the best teacher. Until you only have your own policies, until you start using it, this is the hardest point to get across to people. I think you've had that experience as well. We talked about it, and then once you got your own policies, once you started applying these same processes in your life, then things really started to take, and they made sense, and they really started to take off, right?
Yeah. And this is maybe jumping ahead, but as I began to build and see how it worked in borrowing that money back, it's super cool to look at it and say, oh, money, now I'm paying this back into my own account. So instead of the account, it's gone forever, now it's back in my account. It's just this back and forth. Unlike talking about car loans, now that money is just gone, now you pay the bank and it's back.
Yep, it is. And then for every dollar you pay back in principal, you have that dollar to use again without anybody to say so. And that's the real cool part. Now, what happens is as you take a loan out and you set it up and you say, okay, I'm going to pay this loan back, and then any excess interest above what it costs you to borrow the money goes back into the form of premiums back into your policy. But once your policy is filled up, this is where Nelson's talks about you have to expand your system to accommodate all the income. So then that's where he says, well, now you go take out another policy, and you take out another policy. And there's a lot of people that ask this question. I get this a lot, so I'm going to bring this up. Should I have 10 policies or should I have just one? I said, in an ideal world, you just have one big one. But the problem is we don't know what 10 years from now looks like. We don't know what 5 years looks like from now. So we do what we can today, and then as we grow in our knowledge and we grow in our income and we grow and our banking system grows, that's what generates having the need for additional policies on other people, ourselves, our spouses or kids or whatever it might be. It's because we need additional warehouses to store our dollars.
Why don't you buy this house that has 4 bedrooms and this great big backyard so that when your family all fits in this house? You're not there yet. Yeah.
And then what happens is, again, what business are we in? We're in the retail business of finance, right?
Yep.
And our inventory just happens to be cash. So as our inventory has to grow, we just need other places to store our inventory. And that's where the multiple policies come in. But there's no magic in multiple policies. There really isn't. I said, theoretically, if you could just do one large policy and you knew what the future was 10 years from now, that's the way you would go about it. But we don't know that. We don't know what that's going to look like. So that's why we end up. That's why in our family we have multiple policies. That's why Nelson had 54 policies, because he did it one at a time as he needed more capacity. And that's all it was. He needed more capacity, so he'd buy additional policies. The drawback is always that startup feature.
People who have the fear that get older, the cost of the life insurance is more expensive. And so doesn't it hate the benefit of the policy when now I'm 2 years older or 5 years older and I have to get a new policy? If
we approach it from the premium aspect of it, it doesn't, $10,000 is $10,000 minus the inflation effect on it. But only thing difference is buying less death benefit. But again, we're not buying this per se for all straight death benefit. That's a great side benefit, and that's a whole other discussion. But you just end up buying a little less death benefit. So it's not really any more expensive. $10,000 is $10,000. Does that make sense?
Yeah, can you expand?
So most people, see, here's how consumers think, and this is how the industry has sold life insurance. Today you're at 25 years old, and you give, for $2 million, it's going to cost you $1,000 in premium per year. Well, now you're 55 years old, that $2 million is going to cost you $10,000 in premiums per year. Mm-hmm. And so they're looking at the death benefit staying the same, and so they have to adjust their premiums to make up the difference. Where we approach it is we say, again, with our idea of we try to minimize the death benefit, maximize the cash. I don't really care where the death benefit goes. I go, here we want to put in $10,000. If you're 25 years old and put in $10,000, you're going to get $1 million death benefit. I'm just making these numbers up. You're going to get $1 million total death benefit. If you're 55 years old and you do it, you're going to put in $10,000 and you're going to get $200,000 of death benefit. Money's still going to grow. It's still going to accumulate. You can still have access through the loan. All the things are equal except for the amount of death benefit that it's generating for the use of that same dollar. And so we got to get out of the consumer mindset of, oh, it's more expensive. Well, it is, because the insurance company just doesn't have that long a time between your age and the day you graduate compared to somebody that's 25 years old in the day they graduate. There's more likelihood they're going to be around a lot longer. So they have longer to invest and grow and compound those dollars.
Thus the reason that these policies are individual and focused on building cash as opposed to, just like you said, death benefit.
Providing
death benefit's still important, but when we're talking about financing system secondary.
And the interesting part about it is, if we do this right and we fund it right, by the time, theoretically, when we graduate from this world and the insurance company has to pay a claim, we end up with more death benefit by doing this way than by buying just straight death benefit. Yeah. Not initially, but by the time we're supposed to die, theoretically. So it's funny because I hear that as well. You're not talking about death benefit. Death benefit's huge. I've delivered death claims. They're huge benefit. But again, like Nelson says, our need for financing is much greater than our need for life insurance. Now, if we can do them both, and then at the time, statistically, when we're supposed to die, we have more, and we've been able to use a lot more money along the way, isn't that a win-win for the client?
Yep.
And what happens is once you start doing it, you'll add as your income grows, as your knowledge grows. And there's the idea in here that your income should equal, your premium should equal your income. That's a theoretical idea because as your income, hopefully your income is growing in leaps and bounds each and every year. And to the point where your premium can't probably keep up to what that is. It's just a theoretical idea that that's what we want to strive for. In a perfect world. We don't live in a perfect world, but in a perfect world, that would be what the situation would be. But so in absence of a perfect world, we're going to do the best we can in order to get there. It's interesting because I get people talking about this one as well, and probably because it's just mentioned in the book, and a lot of people can grab onto this idea. So we talk about buying cars, right? So the idea is we can finance cars. And again, the reason why Nelson used cars, it was just because it was easy for people to understand and grasp because everybody has one. Then he gives an example of how we can use our imagination. In this chapter, he says, this is just an example of how we can use our imagination to say, what if we self-insured for our vehicles, for the comprehensive and collision, right? We still need liability coverage. That's by law, you need that. So we're not saying don't do that. But if we haven't borrowed the money from Wells Fargo, they're not requiring comprehensive and collision. But if we're smart, and hopefully we're pretty smart, we should require it because we lent that money to the Borth family bank, lent it to Wade Borth to buy that car. So Borth family bank should say, hey, we need insurance on that car, collision and comprehensive, because if it gets wrecked, we want to get paid for it. What if we would take the rate of the premium that we were paying, pick a company, American Family or whoever it might be, we're paying that rate to somebody else, and we put that in our own policy so we could self-insure our own vehicles for that.
Yeah.
And what would it be? It's easy to get a rate. You just call the American Family and say, hey, what's the rate on this thing? And they say, okay, for a zero deductible, this is what the rate is. And that's what we should be doing. And that's the money that should be additional money that we're putting into our policy in the form of premiums. Again, if we're maxed out, then we might have to start another policy because our property and casualty insurance maybe is $2,000 or $3,000 or $4,000 per year. So now that's in place for a new policy, right? So again, he isn't advocating that you do this. He's just saying think and use your imagination because now here's an opportunity. And I get a lot of people, that's immediately where they want to go. I'm like, whoa, wait a second. He's in here, he makes a really good point. He says you have to have sufficient capital to be able to do that. Because of that, he says you have to get a substantial capital in order to do that. So it's not the first thing I would do. I would build up your policies and build up your cash. Because what if you bought a vehicle today and you said, I'm gonna self-insure, I'm gonna do the comp and collision on my own, and I put that first $3,000 of auto insurance into my policies, and the next day I wreck. Now I don't have enough capital to buy the next car. So you got to make sure that it's done. Not everything's going to be able to happen all at once.
And Wade, this is another one of those areas where when I first read this book, my reaction was to, I don't think I would ever do this. And so I appreciate the fact that he is not saying this is how you have to do it. He's not telling you anything about how you have to do it, anything. He's just saying, hey, don't get stuck in this mindset of this is what's always been done, and so this is how I have going forward.
Exactly. Because in here, he just describes the reason why he did this one. I had a lot of discussions with him about this, is because all a property casualty insurance company does is the same exact thing that a life insurance company does. They have rate makers, they have actuaries, they have a legal department, they have contracts. And so if you're buying into that, hey, I'm going to store my money in a company that uses rate makers and actuaries and contracts and so on and so forth, why not do it within my own system? And again, he says, I'm just using that as an example. I want people to think. He says, this is a great way for just thinking out of the boxes. Hey, this is just one idea out of millions.
Yeah. On
how you could be doing this. And this is a good example of, if I would take that premium that I'm paying American Family, for example, and I put that somewhere, this is the reason why I have to have multiple policies. Expanding your system. He called it expanding your system. The more you start to think, the more you start to use your imagination, the more you're going to have to expand your system to absorb those dollars, that inventory of cash that you're going to have. So again, it's your warehouse. Where are you storing your inventory? And that just happens to be in a properly structured life insurance policy, which is, again, it's a contract between like-minded people. Why do we use insurance companies, mutual insurance companies? Is because you're in contract with like-minded people. And then towards the end of this chapter, he does talk about, he says, remember to play the game. So if you're doing your home mortgage, always assume that you're giving that loan, whatever loan, it doesn't have to be your home mortgage, it could be anything. Whatever loan you're doing, assume that if you're giving this loan to your neighbor, what would you charge? And make sure you're doing the same thing at a family level. Knowing, and this is the biggest difference, and he never really addresses it here, but this is what I found. What if things change in life? I go out and let's say I need $100,000 to go into a business or whatever it is. And so I go and I go to my insurance company, I need $100,000. I borrow from them, from the insurance company, and life changes. All of a sudden now we can't make that payment, or whatever the situation is. Can we change the rules on that loan? Can we change the payback? Can we do interest only? Can we do no interest, no principal? Not a great long-term strategy.
We get to make all those rules.
We get to make all those rules.
Be paid back, but we get to choose when and how.
Right. So think how valuable that is. Do you think, if you buy a rental property and it doesn't cash flow for the first 6 months, do you think Wells Fargo is going to go, yeah, just, don't worry about it. We'll catch up with you later. Or are they going to be knocking at your door?
I'm good for the money, I promise. Just give me 6 months.
Yeah, exactly. This thing will start cash flowing in 6 months. I'm positive. And they're going to say, Nicole, I love you to death. So therefore, just go ahead and do. I trust you.
Yeah.
No, they're going to be knocking on your door in 30 days and say, we want payment. We want it now. Yeah. So that's not really talked about in this chapter, but it's just one of those things that I find is a huge relief, in the sense that we control the system. Now, again, with that comes the discipline. You can't abuse it, but we also know that life throws us curveballs. And so what are we doing to set ourselves up for either opportunities or chaos? So, because, again, if you're able to absorb that, and then you're able to take advantage of chaos, because chaos breeds a lot of opportunities, then we're going to need more policies. We have to be able to expand our system even more, because now we're going to have more cash flow items coming back to us. Good. Anything else on that chapter? It's a short chapter, but it's really strong. There's a lot of misconception out there around this chapter, but I think it's just really important to understand that treat yourself and your family better than you treat every other lending institution, and use your imagination. Think of different ways that you can say, hey, I'm going to capture some money that's flowing somewhere else, and I'm going to put it back in my system. And then if that's the case, how do we expand it? So I have policies on my family. I have policies on business partners. I have policies on other people that I've had an insurable interest in the past that I don't have insurable interest today anymore. So there are a lot of opportunities. And somebody, again, a lot of times I hear, like you said, I'm too old for this. No, you're not. Quite frankly, it's the only time you're too old is when it's in your head to think that way, because you're going to need cash up to the day you die.
I do want to add this. The first comments when I started exploring infinite banking, one of the first comments that was made to me was all my groceries and my gas and all that through this type of policy. That doesn't make any sense at all. And that's not really what we're talking about here. Now, You could, if you wanted to run all of the expenses through a policy, you could do that. But that's such a small way of it. We're going to take a policy and we're going to just essentially turn it into this check. That's not what this is at all.
Absolutely not. Absolutely not. 100% opposite of that. If you're going to choke on the gnats, you're going to have a tough time eating the elephant.
Yeah.
So a lot of people, that's where they want to go. They want to get down to minutia and thinking that's making a difference. Again, we are our first best customers. But quite frankly, where you're going to really grow wealth that's outside of your own pockets is by accumulating a bucket of money that can be lent out at any time for any reason that you see fit. And once that happens and people know about it, they will be coming to you to find deals. And that's where you're truly going to grow wealth.
Yeah.
So and I've talked to clients like that, they're like, oh, I can do all. Insurance company is not designed for a checking account. It's a thought process that we want to take control of the banking function, right? We don't want to take control of the checkbook function. We want to take control of the banking function in our lives.
That is a really good distinction there. We don't want to take control of the checkbook function. That's something we should be controlling, but we're taking control of the banking function of the process.
Of the process. And understanding how, again, do you think banks make a lot of money by having checking accounts? They used to make a lot of money because of the fees and stuff, but there's so many competition out there that, in essence, banks make very little money. The reason why they do that is to bring you in the door and to get you customers, to have you deposit and hold money there, hold money in your checking account, because then they can put that money to work for them. They don't make money by running checking accounts. That's labor-intensive transactional work that costs them money, quite frankly. Where they make money is you come in there with $300,000 and you set it in your checking account or your savings account and you never touch it. That's where they make money, because they lend that money out all day long, multiple times every day.
Yeah.
And that's the part we have to understand and we have to take control of. Let the banks do the transactional stuff. That's a lost leader. We don't want to be there.
Yeah. Perfect.
And again, and then if I've heard people say, I'm uninsurable, what can I do? There's potentially a lot of different options. And sometimes it comes down to that eventually there's nobody that we can take a policy on. And then it's just like, okay, let's take the second best option. If you understand the first best option, you would apply the same principles, and there's no place for you to warehouse your wealth. Maybe we can, again, I think we're always able to find somebody we have an insurable interest on. And if not, that has to be a separate discussion, what we can do at that point. Yeah. But rarely do we find people that we can't help. But again, it all starts with understanding what the problem is, wanting a solution to that problem, understanding the process, because again, infinite banking isn't a product. Nelson said that in the introduction. It's not a product, it's a process. And then ultimately, what is the best product for that process? And that's what we call the warehouse. That's where we warehouse our dollars. And again, that's where Bank of America keeps $24 billion of their inventory.
Yeah.
So, anything else?
I think that's it.
Thank you so much. I appreciate your time on this today.
Thanks.
Although it doesn't seem like I let you get a word in edgewise, but
nah, that's a good conversation. Thank you.
Thanks so much, Nicole. We'll be talking again. If you're enjoying this podcast or know anyone else that might be interested, please be sure to hit the subscribe button and please leave a review. This will help this podcast reach and help more people by ranking higher in searches and ultimately help more people get out of financial bondage. And don't be afraid to share this podcast with your friends and family, as we can be easily found on Apple Podcasts and Spotify.